After the second fabulous day in a row, we have to ask ourselves if this rally could have some real legs. Now, regular viewers know that I've been very skeptical of some of the games here. Last night, I told you this move is mostly about sentiment with a dash of cooler inflation data. People got too negative, and we were due for a bounce. That doesn't mean the underlying fundamentals have changed. Except today, we finally got some good news on the wage inflation front. This is the most intractable issue that's making the Federal Reserve want to wreck the economy with a series of aggressive rate hikes. But if wage inflation cools down, the Fed has less reason to keep going nuclear on us. And today, we got an encouraging job openings number with the biggest monthly decline in job openings in 2.5 years. While the number of job openings is still high by historical standards, it's moving rapidly in the right direction, which made us feel like maybe the Fed's making real progress in the fight against inflation. I know I felt that to be the case. And if it is the case, could it be time to take a more constructive attitude toward the market? To answer that question, we're going off the charts with the help of Larry Williams. Yes, the legendary technician and market historian who's been the #1 expert in the space since I was indeed a zit-encrusted teenager. I have makeup you can't tell. Larry's written over a dozen books and created a host of his own proprietary technical indicators, which you can find on his website, ireallytrade.com. Everybody uses it. More importantly, he's got a stunning track record, especially since the start of the pandemic. I say this every time because it bears repeating. Larry's the guy who called the bottom in April of 2020, back when everybody else was still scared out of their wits by the COVID lockdowns. Stocks were trading like the economy had no future. Yet the market had already bottomed. We just couldn't bring ourselves to believe it yet. Larry explained business would start going back to normal within a month, and he absolutely nailed it, calling one of the greatest rallies I've ever seen, at a moment when hardly anyone else wanted to stick their neck out. Now, he's been also doing something that you should be aware of, telling us repeatedly this year, and I've shared this with you, repeatedly this year, that we had to get through the historically horrible month of September before we could have a sustainable rally. But we would have a sustainable rally once we got past September. Well, how prescient is that looking? And right now, Williams, well, of course, is feeling pretty bullish. Based on history, he wouldn't be surprised if the current rally stalls out of tack. But he expects a meaningful bottom toward the end of the month, followed by a strong run through Election Day. In other words, he thinks you should be prepared for a terrific buying opportunity, even if the current move gets repealed. Or actually, I should say, especially if the market gets repealed. Historically, by the way, just looking at midterm election years, this is an aside, Larry tells me if you bought the Dow Jones Industrial Average on the first trading day in November and then sold it for the election, Williams points out that you'd have 12 wins and 1 loss in the last 13 election cycles. I'm calling that more than luck. Now, I want you to take a look at this chart of the S&P 500 futures in black with what Williams calls the true seasonal pattern in blue. This pattern is based on the historical action of any given point in the year. He notes that typically the market tends to bottom in mid to late October, and that's often followed by a very powerful rally. And of course, we're having this up here, so it might give it up there, but, look, you've got to be in. Now, check out the Dow Jones Industrial Average with the same true seasonal pattern. Again, same story. Dow tends to have a double bottom from mid to late October, followed by a tremendous run in early November. In short, history tells Williams we could be getting a very good buying opportunity coming up real soon. Again, I point out, so we have this nice little rally here. That could be this. Then we might have a leg down. But I want you to be able to buy the leg down, not sell it. That's what's so important. Finally, let's talk valuation. Historically, the average price to earnings multiple of the 30 stocks in the Dow Jones Industrial Average has oscillated between 8 times earnings at the low and 25 times earnings at the highest. Right now, the current forward multiple for the Dow is 15.6 times earnings, down from 22.5 times earnings at the end of last year. Yeah, the market was very expensive. Does that mean the market's gotten undervalued? All right, to put these figures in context, Williams has to do some math, and he likes to compare the Dow's price-to-earnings multiple with the average long-term return on stocks, which happens to be roughly 10.45% per year if you include dividends. To make it comparable, he multiplies the Dow's price-to-earnings multiple by 55%, then subtracts the total from 20.5, the average multiple. The result gives you a rough expected return if you buy the Dow at a particular valuation. I know this is hard. You got to stick with me. So at the end of last year, the average Dow stock was trading 22.5 earnings. Put that through Larry's equation, multiply by 55%, subtract by 25.5, you end up with 8.125. And that's more than 2 points below the market's historical average performance. Not worth it. So if you buy when the Dow's trading 22.5 times earnings, the back of the envelope method says you should underperform the historical average by at least 2.37%. Now, though, the Dow's come back. It's all the way down to where it's trading at 15.6 times earnings. Run the numbers, we get a projected return of 11.9%, about 1.5% above the historical average. As Larry says, this is bullish. I'd say I'd feel better if I knew the earnings would next year would actually be able to sustain and hit those estimates. But when the information comes from Larry, I like to be more constructive because he's got such a stellar track record. But is this relationship between valuation and expected return really that robust? Take a look at this chart showing the action in the Dow in blue and the Dow's price to earnings multiple in orange. Historically, you've done very well if you bought the market when valuations got beaten down to these levels. As Williams sees it, when the Dow trades at 15 or 16 times earnings, well, that has been a tremendous buying opportunity. And you can look through time. When you see that PE go low, it's the time to pull the trigger. He thinks it makes sense to be on the long side right now. Although ideally, again, he says you should wait for that pullback. I showed you in that October line where the pullback would be, because the best time to buy will be when the market makes its first higher short-term low. If that comes in 2 or 3 weeks, it would coincide perfectly with his historical pattern. We are using a lot of his work right now for the Charitable Investment Trust, okay? We are using it because we think he's going to be so right. That's why we offloaded some stock today, and we'll continue to do the same. And look, if we get more encouraging inflation data over the next few weeks, something that seems like a real possibility now, then this call could be right as rain. Again, a bit of a drop, and then the advance. Bottom line, the charts as interpreted by Larry Williams suggest that the bear market is more or less, for lack of a better word, toast. And even if the current rally stalls, he's predicting a big move either toward the end of the month or the beginning of November. I hope he's right. And given that I know no one who shares his bullish view, just like his bottom call in April 2020, there may be a lot more to this than just hope. Let's take some calls. Let's go to Fletcher, North Carolina. Fletcher.
Cramer, how you doing? Thanks so much for taking my call. I love your show.
Thank you, Fletcher. I really appreciate it. What's going on?
Yeah, I'm just interested in your opinion on Duke Energy, ticker symbol DUK. Just basically curious as to your opinion of increasing my shares. I've basically got a long-term position with this.
I happen to like Duke very much. I think that overall we're going to get to a more level inflation rate. The utilities have done incredibly well here. I think Duke is one of the best. You know, I like American Electric Power best, though. All right, let's go to Mark in Massachusetts. Mark.
Jim, booyah.
Booyah, Mark.
All right, I'm here to talk about Starbucks. I know that you're very bullish on them. I'm curious about that based on their avowed revenue growth policy in China. Based on the volatility and the uncertainty in China, doesn't that represent risk that could be a problem?
Well, I want you to go back and look at our interview with Howard Schultz, who's the founder. I think he's made a very good point that they're doing well in China, better than almost every other company, even with this bear market situation they have from COVID. And so therefore, when things get better, it's going to be amazing, particularly with the cold brew changes they've made. I think that after spending some time with Howard Schultz in Seattle for his retirement, I came back more bullish than I've been for Starbucks since, I don't know, perhaps the second time when Howard came back. Well, let's just put it this way. I think that Howard is a winner. The first time he came back, I nailed it. And this time, I think I'm going to nail it again because of Howard, not because of me. The charts, as interpreted by Larry Williams, suggest that the bear market is more or less toast. And even if the current rally stalls, he's predicting a big move either toward the end of this month or the beginning of November. So he doesn't want you to sell everything into this rally. And I hope he's right. Much more Mad Money ahead, including my exclusive with Biohaven. After Pfizer completed its acquisition of the biotech company, I'm learning more about what the future could hold for the company after the transaction with the CEO. Then, the SPAC attack has turned sour. So is there hope for the once red-hot cohort? I'll give you my take and all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.